Welcome back to the deep dive. Today, we're plunging into something really foundational for anyone wanting to grasp how businesses operate. We're talking about managerial accounting. Basically, how companies figure out what things really cost.
And why that matters, right? It's not just about the numbers.
Exactly. Our mission today is to, cut through the jargon. Like, think about a small bakery, Fresh Bake. They know flour costs, but why are some months unprofitable?
Yeah, it's those hidden costs. We're giving Fresh Bake and you the tools to see the full picture, from ingredients right down to the delivery van.
And this isn't just for accountants, is it?
Oh, definitely not. It's like the secret sauce for making smart decisions for anyone in business or even just, as a consumer.
Right.
We'll look at different cost types, how they influence choices, expect some aha moments. Think of it like getting financial x-ray vision.
I like that, x-ray vision. Okay, so let's start basic. What is managerial accounting? How's it different from, say, financial accounting?
Great starting point. So managerial accounting is all about info for internal folks.
Managers, employees.
Exactly, for making future decisions. It's forward-looking. Financial accounting, that's more for outsiders.
Like the tax authorities, banks.
Right. And it has to follow strict rules, reporting on the past. Think of it like this. Financials are the rearview mirror showing where you've been for compliance.
Okay.
Managerial accounting is your GPS. It guides you forward, helps you adjust. It's about making history, not just reporting it.
That GPS analogy works. It's active. So it's about shaping the future, not just avoiding big mistakes.
Precisely.
Which brings us neatly to today's main theme, costing your product. Every business needs to know this total cost, right?
Absolutely. From Fresh Bake to a giant tech company.
And these costs fall into two big buckets?
Yeah, basically. You've got production costs, think manufacturing, and non-production costs, non-manufacturing stuff.
Okay, let's zoom in on manufacturing costs first. These are the expenses when you turn raw materials into, well, finished goods. And there are three key elements here. Can you walk us through them? Maybe touch on the tricky bits.
Sure. First up, direct materials. The obvious stuff, flour for Fresh Bake's bread, wood for a table.
Things you can physically trace.
Exactly. They become part of the product. But the tricky part, accurately tracking the cost. Supply prices fluctuate, there's waste.
Little variations add up.
They really do. Even small changes can hit profits hard.
Makes sense. What's next?
Then you got direct labor. This is the pay for people actually touching the product.
The bakers kneading dough, assembly line workers.
Right, people transforming the materials. It's crucial to separate this from, say, the factory cleaner's wages. Their work supports production, but isn't direct.
And the complexity here is efficiency.
Yeah. How productive are those hours? How do you optimize them? It's a constant balance.
Okay, and the third one, often the most mysterious.
Manufacturing overheads. This is everything else needed for production in the factory, but not tied to one specific unit.
The hidden support structure.
That's a great way to put it. It's the supervisor's salary, the factory rent, the electricity for the machines.
What else falls in here?
Oh, lots. Indirect materials like glue or machine oil, depreciation on that big dough mixer Fresh Bake bought, factory insurance, even quality control checks.
Wow, okay. That's a much broader category than I first thought. So with all these different costs, how do businesses track it all? Where does the info come from?
Good question. Because bad data means bad decisions. For direct materials, you're looking at purchase orders, supplier invoices, detailed inventory logs.
You okay?
For direct labor, it's timesheets, clock cards, payroll records, employee files.
Right.
And for manufacturing overheads, it's a mix. Asset registers for depreciation, lease agreements for rent, utility bills, insurance policies. You get the idea.
It's like putting together a complex puzzle.
Exactly. Every piece matters for the true cost picture.
And connecting this back, you mentioned something earlier about how this impacts profit reporting. Product costs versus period costs.
Yes, absolutely crucial distinction. This isn't just jargon. It affects your reported profit and how you value inventory.
So?
Well, product costs, that's our direct materials, direct labor, and manufacturing overheads, they stick to the product.
Attached to the units.
Right. They only become an expense on your income statement when the product is actually sold. Until then, they sit on the balance sheet as inventory, an asset.
Okay, so wait, what about period costs?
Period costs like admin salaries or marketing are different. They're expensed in the period they happen, regardless of sales.
So they hit the income statement straight away?
Immediately. Think about a startup spending loads on marketing. That cost hits their profit now, even if sales take time. How you classify these costs can really shape how investors see the company's health, especially early on.
That's huge. It affects perception, funding, everything.
Okay, let's flip to the other side then. Non-production costs.
Yeah.
Not directly making the product, but still essential.
These are vital for the business to actually function and sell. Usually two main types.
First, administrative costs.
Mm-hmm.
General management stuff. Executive salaries, depreciation on office equipment, like FreshBake's front desk computer office cleaning staff.
Keeping the overall business running.
Exactly. And second, marketing, distribution, and selling costs. Everything needed to get orders and deliver the product.
So FreshBake's ads, sales team commissions, the delivery van costs.
Precisely. And remember, these non-production costs, they're always period costs.
Always hitting the profit statement in the current period.
Yep. No waiting in inventory for these.
Okay, we've covered the main categories, but there are other ways to slice and dice costs that help with decisions, right? Let's touch on a few key ones. How about controllable versus uncontrollable costs?
Right. This is about whether management can influence a cost in the short term. Controllable costs, management can change them relatively quickly, maybe adjust direct labor hours, cut back on some supplies.
Okay.
Uncontrollable costs, they can't change them easily in the short run. Think FreshBake's factory lease. It's fixed for the lease term.
And why does this matter?
Performance evaluation. You can't really blame a manager for high rent if they had no say in the lease agreement, right? You judge them on what they can control.
Makes sense. Okay, next concept. Sunk costs. Costs already spent, can't get them back.
Exactly. Imagine FreshBake bought a fancy R50,000 oven last year. Now they're thinking of changing their product line. That R50,000, it's sunk. Gone.
Irretrievable.
Right. Whether they change the menu or not doesn't bring that money back. The key thing, ignore sunk costs when making future decisions. They're irrelevant to what happens next. Focusing on them leads to bad choices, trying to justify past spending.
Don't throw good money after bad, basically.
That's the idea.
Okay, and one more. This one can be a bit counterintuitive. Opportunity costs.
Yes, the what-if cost. It's the value of the next best alternative you give up when you make a choice.
So not cash out of pocket, necessarily.
Not usually. Let's say FreshBake uses R100,000 of its savings for a big marketing push.
Yeah.
The opportunity cost isn't just the R100K, it's maybe the interest they could have earned keeping it in the bank.
Or profit from buying a better oven instead.
Exactly. It's the benefit missed from the option not chosen. It's a real economic cost, even if it's not on the accounting books. Forces you to think strategically about resource allocation.
That really does change how you weigh decisions. Okay, let's shift gears slightly, how costs behave. Specifically, how they react to changes in production volume. We're talking fixed and variable costs. Foundational stuff for planning, right?
Absolutely fundamental. Let's break them down. Fixed costs. The total amount stays the same, regardless of how much you produce, within a certain range anyway.
Like FreshBake's rent. Whether they bake 100 loaves or 1,000, the rent is the same that month.
Exactly. Rent, insurance, maybe depreciation on equipment, using the straight line method. But here's the interesting part. The total is fixed, but the fixed cost per unit goes down as you make more.
Right. You spread that fixed cost over more loaves so each loaf carries less of it. That's a key path to efficiency.
It is. Then you have variable costs. The total amount changes directly with production volume.
More loaves mean more flour, more yeast.
Precisely. Direct materials, direct labor, paid per piece, maybe some utilities. With variable costs, the total changes, but the cost per unit stays the same.
Each loaf needs roughly the same amount of flour, so that cost per loaf is constant.
Correct. Though we should also mention there are hybrids. Semi-variable costs like a phone bill with a fixed line rental plus charges per call. And semi-fixed costs, sometimes called step costs, like a supervisor's salary. It's fixed for a certain production range, but if you need to produce way more, you hire another supervisor and the total cost jumps up a step.
Okay, this is getting clearer. Let's make it concrete. Time to unpack that example. Let's say furnishers making Jupiter star sets. Let's calculate their total monthly costs for making 200 units. This is where the rubber meets the road.
Let's do it.
Okay, 200 sets, starting with direct materials, the wood. Each set needs 20 kilograms, and wood costs R30 per kilograms. So 200 units times 20 kilograms times R30. That's R120,000.
Got it. R120,000 for wood. Next, direct labor. The craftsmen get R400 per set.
Okay, so 200 sets times R400, that's R80,000 for direct labor.
Right. Those are your prime costs, often the biggest variable chunk. Now for the manufacturing overheads.
This is that mix of factory costs: supervisor salary, rent, rates, polish, glue, insurance, quality control. Adding those up from the source, it comes to R19,100 for the month.
Seems small compared to materials and labor, but it adds up. It shows all those little indirect things needed.
Definitely. So total production costs, that's R120,000 plus R80,000 plus R19,100 equals R219,100.
Okay, so R219,100 is the cost attached to making those 200 sets. That's the cost sitting in inventory until they're sold.
Right. Now for the non-production costs. First, marketing, distribution, and selling. We've got sales commission, advertising, delivery costs. Adding those gives us R122,500.
And the other part, administrative costs. Here it's just the assistant's salary, which is R1,000.
So total non-production costs are R122,500 plus R1,000. That's R123,500. And these are period costs, right?
Correct. Hitting the income statement this month. So the final step, total cost for 200 units.
We add the total production costs are $219,100, and the total non-production costs are $123,500.
Which gives us $342,600.
Wow.
That's the grand total. It gives Let's Sama a real baseline, shows everything involved, not just the obvious stuff. Absolutely crucial for setting a profitable selling price.
A real masterclass in pulling it all together. So what's the payoff for all this detailed costing? You mentioned strategic tools like break-even analysis.
Exactly. All this feeds directly into tools like break-even. It's incredibly powerful.
What is it exactly?
Break-even analysis tells you the point where your total revenue exactly equals your total costs. Zero profit, zero loss.
The absolute minimum you need to sell just to cover everything.
Precisely. It answers the question, how many units does Fresh Baked need to sell just to keep the doors open before they make even one random profit? It's fundamental for setting realistic sales targets and understanding pricing implications.
And that fixed versus variable cost behavior is key here. Let's quickly revisit that Zondi manufacturer's example with the ashtrays. Their fixed cost was $14,500 a month.
Right. And that total stayed the same whether they made 1,500 or 3,300 units.
But the fixed cost per ashtray plummeted from R9.67 down to R4.39 as volume went up.
That leverage effect. But look at the variable cost, R5.80 per ashtray. That stayed constant.
Or always R5.80 per unit.
But the total variable cost shot up with volume, from R8,700 to over R19,000. It moves in lockstep with production.
Understanding that difference in behavior is everything for break-even calculations.
It's the absolute bedrock. You need to separate fixed and variable costs accurately to do any meaningful break-even or profit planning. Without it, you're flying blind.
Definitely not flying blind anymore after this.
Yeah.
What a deep dive. We went from the why of managerial accounting through all the cost types, saw them in action with Let's Sama Furnishers, and landed on how it all fuels tools like break-even analysis. It's quite a journey.
It is. And while it might seem like a lot of numbers, the core idea is knowing your costs, understanding how they behave, they're universal. Hugely valuable for any business, big or small, or even just for understanding the world around you better.
Absolutely. And to wrap up, here's something for you, the listener, to think about. Now that you understand these concepts a bit better, how might it change how you look at prices? What hidden costs, fixed, variable overheads might be packed into the price of your coffee or your phone?
Or if you're thinking of starting something, maybe like Fresh Bake, how can this knowledge help you plan for actual profitability, right from day one, turning that passion into something that lasts?
Great questions to ponder. Keep exploring.